Good morning, good afternoon, good evening, everyone, from wherever you might be listening to my voice. This virtual class is designed for the 100 level accounting student of the University of Ibadan. This is a virtual mode of learning using learning management system put in place by the management. So in the next 6 weeks, our discussion shall be online, and this is second semester course, and it is my pleasure to once again congratulate you on your admission to the Premier University, the first and the best. I wish you a successful and rewarding academic sessions. You are welcome to the Department of Accounting once again. My name is Dr. Abosede Tiamiyu. I shall be facilitating this course for this semester. Also, I double as the coordinator for the undergraduate program. So I'd like to introduce you to the course outline for the semester. Here we shall be taking a look at the accounting concepts and conventions, control accounts, accounts for non-current assets, accounting of a sole trader, mathematics for accounting discounts, markup and margin, manufacturing accounts, correction of errors, bank reconciliation statements, account of not-for-profit making organizations, as well as introducing you to the framework regulating financial reporting, particularly as far as financial accounting is concerned. But let me also add that as we have the course outline, we still have some other things to cover under each of the highlighted outline. For instance, accounting for non-current assets at this stage shall be taking a look at what asset register is. What does it mean? What are the contents? How do we manage non-current assets? That is, these are class of assets that cannot be easily converted to cash, and they are expected to continue to be used by an entity over and over again. So at the end of this discussion, students are expected to have some learning objective. And for the purpose of virtual class, of course, we might not be able to cover everything as we highlighted here, but for the purpose of the semester, these are all that is expected of us to cover. So, as time permits, at the end of the lecture, students are expected to be able to identify and explain usefulness of accounting concepts and convention, particularly as it relates to the financial statement. You are also expected to give us an idea of your understanding of the relationship between a business and its owners. Then we want to see the elements of a financial statement. What are those things we should be on the lookout for in a copy of financial statement? Students are also expected to be able to distinguish between what an asset is, what a liability is, as well as owner's equity. Of course, the first semester, you must have been introduced to some of these elements, particularly the assets. When we say assets, what do we really mean? What exactly are we talking about? But as we progress in our discussion, we get more enlightenment as regards the definition and various classes of asset as well as liability and the rest of the course outline. So, starting with the accounting concepts and conventions. This refers to general assumptions guiding the preparation of financial statements. Of course, there are assumptions, several assumptions in accounting that has to be put to mind while presenting preparing and presenting the financial statement. Those assumptions they enable an accountant or whoever the preparer of financial statement is to be able to be consistent in the application of a chosen item or method. So these assumptions cut across every preparer of financial statements. And I start by taking the first one, which is known as going concern concept. The belief of this concept is that a business, once it is established, is expected to be in operational existence into the foreseeable future. Businesses are not expected to die. And when we say dying of a business, meaning that a business is not expected to be liquidated. A business is not expected to be out of business. A business is expected to be continuing, to survive for several decades. So we do not envisage the end of a business. That is the belief of going concern concept. So the entity has no intention to curtail its scale of operation significantly or to be out of business. So for the preparer of financial statement as well as the user, this going concern concept should always be at the back of their mind, that the business I am running, the business put in place, the business I'm managing, the business is expected to outlive the owner. Even when the owner is fast gone, the business should still remain in operational existence. That is an assumption. Next to that is the entity concept. Of course, only limited liability companies are given recognition as being distinct from the owners. However, in accounting, all classes, all forms of entities are regarded as being separate from their owners. When we say separate or distinct, we mean that a business should not be seen as same as the owner. Business is an entity on its own, the owner is an entity on its own. That is the position or the assumption of entity concept. So the two should not be mixed together. The business and whoever establishes the business, they are not the same thing. They are separate beings. As far as the law is concerned, they are separate entity. So a business has the power to enter into contractual agreements. It has the power to incur debt. It has the power to sue. It has the power to be sued in its own name and not in the name of the owner. So this assumption is key and is germane. So whenever there's any dealing with an entity or a business or organization, we should bear in mind that the business is different from whoever has put the business in place, or people who came together to float the business. The business is an entity. It has its own right. It has its own power under the law. We equally have money measurement concept. So this assumption believes that accounting transactions are expressed in monetary terms. That is, every accounting transaction, we should be able to quantify it by attaching monetary value to it. So money serves as common denominator for measuring assets as well as liability of an entity. And what constitutes money differs from one country to other. For instance, in Nigeria, we use naira here. In Ghana, they spend cedi. In Europe, they use euro, and as riyal is spent, that's the currency in Saudi Arabia. So each country has its own currency, and of course, as we know, that currency is one of the sovereignty power of a nation. So in summary, we are saying that every accounting transaction should be able to be attached or be attributed in quantified in a monetary term, such that we can have the recording, we can have the value, naira equivalent or dollar equivalent of such a transaction. Nevertheless, not all accounting transactions can be quantified in terms of money. There are some activities that cannot be quantified. For instance, a good management. When the management of a firm is performing, how do we quantify that? Meaning that when they are doing well, when they are ensuring that the assets of the company are judiciously utilized, how do we quantify that? It is not possible. Then the employees' morale, how do we quantify it? We cannot quantify it. And as such, companies, aside from looking at the monetary concepts, they have gone beyond focusing on financial information alone, as might be presented by the management, to demand or make requests for non-accounting or non-financial information from companies. We look at the consistency concept. These concepts agree that there are several ways of treating an item in account without violating accounting principle. However, it assumes that when a method has been adopted for treating an item in the financial statement, the management should consistently apply the method over and over again. There should not be swapping. There should not be just changing method. For instance, when we talk about our asset, there are various methods of depreciating the asset. We have the straight line method, we have some of the digits method, just to mention a few. So the position of consistency concept is that once a company has chosen a method of depreciating its assets, it must be consistent. It must apply that method consistently over time and should not change the method except there is a compelling reason to do so. And when such reasons arises, it must be clearly disclosed in the financial statement. We have prudency concept. This is about being a good manager. The prudency concept requires that an accountant should not recognize income until the income has been earned and adequate provisions made for all known losses. What are we talking about? As an accountant, we should not overstate the company's profits such that we end up giving out dividend or compensating the investors at the expense of the business. No, an accountant must be prudent. He should only report profit after taking into consideration all possible known losses. For instance, if somebody is owing a company and the debt has spanned for several number of months without being paid or without being settled by the debtor, the company cannot fold his arms and ignore that transaction. What the company should do is to make provision for such a debt to be doubtful. That is, the probability of receiving the debt is in doubt. So the management or the accountant must factor that into the activities of an entity during the period under review. So take care of that. That is an a debt that has been forestalled, a liability that has been forestalled. You take it into consideration before you disclose the or you declare the profit at the end of accounting period. So prudence means being wise, being a good manager of resources. Then we have historical cost concept. This concept assumes that asset and liability should be recorded at the amounts of cash or cash equivalents paid of fair value consideration given to acquire the assets. So under the historical cost concept, its position is that once an asset is acquired, it should be recorded at the costs, at the amount of cash paid or exchange for that asset. That asset should be recorded in the asset register of the entity to that amount of cash paid or cash equivalent. So the advantage or the beauty of this historical cost concept is that it enables a comparison. It enables easy access to trace back an asset, to know its worth at a particular point in time. However, it equally has some limitations. For instance, the value of an asset is not static. It changes from time to time. So if you purchase an asset in the last 5 years, you do not expect the price to remain the same as at today. So whatever the value of that asset as at today is the fair value. That's the fair value of that asset. We can no longer go back to the historical cost as a basis of recording that. But the position of historical cost is that no, it is more objective. It devoid less of management judgment, and so the amount expended, the amount paid by an entity to acquire an asset or a liability should be recorded against such asset or liability. We equally have materiality concepts. Under this concept, an item is said to be material if its omission from the financial statement can influence the decision or the choices to be made by users of accounting information. I remember in your first semester you must have been told various users of accounting information as well as their information needs. So if I put it to you now, you should please highlight 3 or 4 users of accounting information. There should not be problem. You should be able to do that conveniently. So materiality concept is of the opinion that an item might be material to company A and that item might not be material to company B. So for instance, we have small businesses, we have medium-sized businesses, we have large or big companies. So an item that is material to a small company or entity might not be material to a bigger company, so to say. So if an omission of an item can influence the kind of decision to be made by the user of accounting information, such an item is material. That's the position of materiality concept. So it's consider an item, it's consider the item of financial statement to be material, subject to the size of business, subject to its resources, available resources. So when a company has more than enough, some things might not be significant, they might not be material, they might have no meaning to such an entity, whereas to others it matters a lot. So what is material to company A might not be material to company B. Then we have accrual or matching concepts. These concepts state that income should be recognized when they are earned and not when they are received in cash. Similarly, expenses should also be recorded when they are incurred and not when cash payment is made. So the position of accrual concept states that once a transaction takes place, it should be recognized. Such should be recognized regardless of whether or not payment or movement of cash is involved instantly. Once a transaction or a deal or a contract is sealed, then such a transaction should be recognized in accounting record, regardless of whether or not cash is immediately paid or received. Similarly for expenses, when an expenses is incurred, it should be recognized in the books of accounts and not until when payment is made. So the purpose or the point of matching concept says that at any accounting period, it should be possible for an entity to match its cost with the income generated for that period. Meaning that when whatever is realized as income for an accounting period, a company should be able to identify all the costs associated to the generation of that income and match the two together. Aside from accrual concepts, we equally have realization concepts. The position of realization concept is that it is concerned with determining when revenue is earned. Don't forget that at the accrual stage, we said income should be recognized as soon as a transaction takes place and not until when cash is received or payment is made. So the focus of realization concept is in determining when revenue is earned. So this concept holds that revenue should be recognized as at the time goods are sold or services rendered. It is possible that a company or an entity or an organization sells goods to its customer. The moment the sales takes place, it should be recognized. It is possible that a company purchases or buys certain items from its suppliers from outside. Immediately the purchases is made, it should be recognized. So that's the point of realization. You want to determine at what point should we recognize a transaction, at what point should an expenses be recognized, at what point should we recognize purchases in the book of accounts. So the moment or the very moment the goods are sold or services is exchanged or rendered, such should be recognized in the accounting record. We equally have objectivity or fairness concept. This beliefs or this assumption holds that financial statements should be devoid of managerial judgment or influence. Management should not be able or should not be allowed to influence the financial statement by influencing or allowing their influence on the financial statement, meaning that the objectivity of the financial statement might be eroded. That objectivity might be compromised. So the point of objectivity is that financial statement should not be influenced by the personal judgment of the management or managers. Those who are at the helms of affairs of an organization, those who runs the organization, we refer to them as the management. So the objectivity of fairness concept is saying that at any point in time, they should not be allowed to influence the financial statement. so that objectivity can be maintained. We have substance over form. Like I said at the commencement, that businesses are different from the owner, and that's the perception of law, particularly the listed companies. But as far as accounting is concerned, all entities are distinct from their owners. For substance over form, it says that businesses are governed by legal principle. Nevertheless, transactions are recorded and accounted for in accordance with their financial substance and reality, and not merely by their legal form. We recognize an item in the financial statement based on its substance, and that's why there is the need for this bookkeeping. We keep record of all transactions. This is giving us more detail about that particular transaction. It's giving us more insight about that particular that particular item recorded in the account. So it's giving us information about the substance of that item, and it is the substance that can be recorded, and aside from recording, that can be accounted for. Without the substance, we cannot just be saying a company has existed simply because it is recognized by law as an entity. So the substance of an entity really matters. The substance, it plays a significant role. We cannot do away without the substance and reality of an item in the financial statement, simply because they are governed by legal principles. I hope you are with me. For the sake of your level, 100 level, we believe that we should not choke you with so much, and so always make room for breakout session. At this period, we give you time to ruminate or go through what we have just discussed. Go through it. What is your understanding of what has been said? Are there areas requiring more or further clarification? If you are asked as a student, what can you say about so and so as just discussed? So these are what we expect you to do at the breakout section. And so I want to appreciate you for staying patiently while the lecture lasted, and I hope to see you in part B class of this discussion as we progress. Thank you.